So today I want to talk to you about why I believe cryptocurrencies literally could save the financial world, could save the world, could save your life potentially. And granted, that sounds a little bit far-fetched, and it is, but it's not as far-fetched as you may believe. I think most people walking around in developed countries today are oblivious to the potential fears that are facing us. These are very real fears, and they're getting covered in the mainstream media, but they're oftentimes little aside story. I saw this today on a popular news website, Drudge Report, and the headline was just "Global Debt Soars." And I thought, what is this all about? So I opened it up and I read through it. Listen to this. 10 years after the worst financial panic since the 1930s, growing debt burdens in key developing economies are fueling fears of a new crisis that could spread far beyond the disruption sweeping Turkey. Most people don't even know there's a financial crisis in Turkey. The loss of investor confidence in the Turkish lira, which has surrendered more than 40% of its value this year, is only a preview of debt problems that could engulf countries such as Brazil, South Africa, Russia, Indonesia, and some economists say. Now, most people don't even really understand what that means. So what this would mean is, if you were looking to buy a house and the house costs $200,000 right now, if the dollar lost 40% of its value, that same house would take $280 to purchase a year from now, if the dollar were to lose 40% of its value in a one-year time frame. So imagine how much more gas would be. Gas would be 40% more. Bread would be 40% more because the dollar will not buy as much as it used to. That is a real issue here for the Turkish lira. That's exactly what's going on with them. But what does that mean for us? Turkey is not the last one, said this guy, an economics professor at the University of Maryland. Turkey is the beginning. For now, few experts think that a broader crisis is imminent, though Argentina this week asked the International Monetary Fund to accelerate a planned $50 billion rescue as the peso crashed to a historic low. But the danger of a financial contagion that could hit Americans by crushing U.S. exports and sending the stock market plunging should be taken more serious in light of a massive increase in global debt since the 2008 downturn, the economist said. So this is how it could affect America. It could affect the American stock market and American companies. The total debt is a whopping $169 trillion, up from $97 trillion on the eve of the Great Recession, according to the McKinsey Global Institute. While previous debt crises involved U.S. households and later prolificate European governments such as Greece, this time the concern centers on companies in emerging markets that borrow heavily in dollars and in euros. This is a key phrase. This is broken down. If you have trouble understanding this, and some people do. Now, others of you have very good economic mathematical brains and all this makes sense to you. But if you don't have a natural economic brain, there's a great video, Money is Debt. I'll link it down below. If you watch that video, a lot of this will make much more sense to you. But I'll continue on for now. In Turkey, for example, companies and banks borrowed in recent years to finance bridges, hospitals, power plants, and even a mammoth port development for cruise ships. Foreign investors, particularly European banks, lent freely in search of the higher returns these markets offered at a time when the U.S. Federal Reserve and European central banks were keeping interest rates low. So this is interesting. Interest rates are low, and this is where central planning, the Federal Reserve is a central body that controls financial decisions that affect all of us. Bitcoin, cryptocurrencies tend to be decentralized. Therefore, there's no one that can artificially lower rates. And of course, people say, well, that's good. It helps us out. Yes, but there's also unintended consequences like right here. Since the U.S. Federal Reserve and the central bank produce low returns, then they're saying foreign investors, particularly European banks, lent freely in search of higher returns to, for example, Turkey. We were supposed to create a debt bubble, said David Rosenberg, chief economist at the Glasgow Schiff, a wealth management firm. What we did instead was create more debt. Because it was cheaper to borrow, people who could borrow chose to borrow more. These bills are coming due, and Turkish borrowers, like those in other developing countries, may not have the dollars and euros to pay them back. This is important to note. If in a foreign situation, if you borrow US dollars or if you borrow euros, you have to pay back in dollars or you have to pay back in euros. Why is this? Well, it prevents Turkey from printing their own money to pay back. That's why. Do you know the only country exempt from this? Predominantly America. America has the dollar is a world reserve currency. America literally prints dollars to pay back its debts at times. Literally. You should, again, take a look at the video, Money as Debt. This is in part because the Fed is raising interest rates in the midst of a healthier economy. The stronger dollar, along with the sinking lira, makes it increasingly expensive for Turkish borrowers to repay their dollar debts. So the dollar's gotten stronger, the value of the lira has went down. So this is what happens. Paying off a $100,000 loan at the start of the year would have required 379,000 lira. Now, that same loan would take more than 660,000 lira. So now what's happened is it's super expensive for them to be able to pay that back. Their free money is going away, said economist Tim Lee, who's been warning of a potential Turkish crisis since 2011. The situation could grow even more perilous. Money is fleeing Turkey in similar markets precisely when many of the loans these companies took out in recent years are coming due. Globally, a record total of up to $10 trillion in corporate bonds must be refinanced over the next 5 years, according to McKinsey. Earlier this week, Moody's cut its credit ratings on 20 Turkish financial institutions. The rating agency cited a substantial increase in the risk that banks would struggle to finance normal operations. The prospect of a new debt crisis is striking because the world has already seen two in the past 10 years. Authorities in the United States and Europe took steps after 2008 to avoid a repeat episode. U.S. regulators required banks to hold significantly more emergency reserves. U.S. consumers whittled down their debts. In Europe, authorities forced overspending governments to embrace austerity programs. By the way, here's the challenge with this. Everybody says we're out of the woods, we're in a recovery, blah, blah, blah. I don't necessarily agree with that because interest rates went extremely low. Some argue even negative interest rates to counteract this crisis. However, interest rates have not been able to get back to where they were at before the crisis. And I don't think it's even possible for interest rates to go up. Again, check the video below, Money as Debt. That will explain why. But I think until we see interest rates back to where they were at pre-2008, it's difficult to say that we've had a full-blown recovery. Yet the debt has grown furiously and is almost 2.5 times the size of the global economy. This is the global debt. As banks in recent years have faced tougher regulatory scrutiny, they have increased their global corporate lending by only a small amount. Cash-hungry corporations increasingly have turned to the bond market. Chinese borrowers have been the most active among developing markets, but 95% of corporate bonds in China are issued in the yuan, minimizing the financial dangers, according to McKinsey. But for other emerging markets that borrowed in dollars and euros, rising interest rates will make it more expensive to borrow new money or refinance existing debt. That could trigger a wave of defaults by corporate borrowers, with problems spreading far beyond Turkey and ultimately into the United States, Rosenberg said. Among the chief casualties from Turkey's plight will be European banks, especially Spanish institutions that have loaned Turkey more than $82 billion. The rising dollar will erode the sale that major U.S. companies book overseas, which amount to roughly 40% of revenue for members of the Standard & Poor's 500 stock index, according to Rosenberg. Others say markets should not be too alarmed. Adam Posen, president of the Peterson Institute of International Economics, said factors such as financial health of lenders, the borrower's abilities to raise cash by selling assets quickly, and central banks' willingness to raise interest rates all matter. And this is the part where they're a little bit more glowing, and you can come and read this entire thing if you want. At the end of the day, what they're saying is, hey, there's a real risk here. We don't know what the outcome's going to be. The problem is, once the cards start falling, once the house of cards starts to fall, you can't easily put it back up. I believe that it's this. If you notice, central planning basically is creating the issue. They're lowering interest rates to fix one problem, but then that creates another problem. That's the issue, and it creates friction in the free market. Normal free markets have booms and busts, ups and downs. And ever since we've had a Federal Reserve, they've worked really hard to try to prevent the crashes from being so deep. But what ends up happening, what it looks like is going to happen, is they just push off what eventually is a massive, massive worldwide crash potentially. And that is actually, it's that sort of thing that could lead to the adoption of something like Bitcoin. And I don't think that is going to happen today or necessarily tomorrow, but I think this is a sign of problems that are not going to be fixed this year or next year or the next 3 to 5 years. At some point, this house of cards, at some point, the weight of the financial debt can't be corrected any longer. And then what happens? Then it's going to be some sort of worldwide restructuring. Now, what does that look like? Maybe people don't trust the U.S. government. That's happening more and more. More people are looking at the China yuan, and maybe more people look at the Chinese yuan, but then maybe they don't want to put all their eggs in one basket. People are talking about a basket of currencies. I think this is when you're going to see governments potentially start looking towards things like cryptocurrencies. So this is oftentimes when I talk about being an early investor, this is what I'm talking about. I mean, this is the Bitcoin is necessary. P3D tokens are necessary for the future of, I believe, the global economy. That's my personal opinion, and that's not financial advice. If you haven't seen it already, go ahead and make sure you take a look at that 45-minute short educational documentary on money as debt. Money as debt. Absolutely everybody should watch that video. Thank you so much for watching.